life insurance and helping protect the most important asset in your life, which is yourself. So my name is Jared Spector. I'm accompanied by my business partner, Alex Demchek, who you'll hear from soon, and we're with Equitable Advisors. So thank you all for coming. I hope you all had a great weekend and a happy Mother's Day to all of you mothers that joined here today. And we're really excited to take the time to present to you this morning. So this is our contact info in case you have any questions after the meeting that we didn't get to cover. Along with this, like Carly mentioned, I'm going to be available for one-on-one consultations next Monday, May 17th. So if you reach out to her, we could take a deeper dive and a more individualistic approach to what we discuss here today. And in the chat box, I'm going to have Alex send a Microsoft Forms. This is completely optional, but of course we appreciate your feedback if you'd be willing to fill it out. So the purpose of this presentation today, I know that discussing life insurance, sometimes it can be uncomfortable and oftentimes quite confusing. So we have two goals here today. One goal is to create a simpler approach to understanding life insurance and educate you on the general purpose of life insurance along with different types. Our second goal and our primary goal is to cover a specific strategy to implement life insurance, which is called pension maximization. This is a strategic plan to maximize your retirement income from your FRS pension plan. Since you all have the option to receive a pension as part of your state retirement benefits, this strategy is going to allow you to take home the most money possible while protecting yourself and your loved ones. Of course, everyone's financial situation is completely unique. So what we go over today with this strategy is definitely going to be implemented differently from household to household. So I'm going to hand it off to Alex, and he's going to go over the main purpose of life insurance in general.
All right. Hey, everybody. I hope everyone had a good weekend. I'm just kind of carrying off of what Jared went over. Some of the common questions we get asked are when you plan your legacy, to whom do you want to leave those assets to potentially? Is it children, grandchildren, any charities you have in mind? Some of the other questions is, do you know how much you want to leave to this organization or your heirs? Do you want to leave as much as possible? Do you want to help out potentially future generations? You also need to make sure you have enough money to retire comfortably. Obviously, you want to leave that money, but you want to have plenty of money for yourself, of course. Also, any unexpected expenses that, may potentially come up in the future. So we're going to take a look at how you can, make enough money with that legacy and take care of that retirement, any unexpected expenses. Our next slide is, we call these our three retirement buckets. We like to say it starts with your three buckets. We have retirement, emergencies, and your legacy. Your first bucket A, your retirement assets, probably in the form of investments, any retirement plans, Social Security. Maybe you'll be even lucky enough, like you do, to have a pension offered to you. Bucket two, we like to call our emergency bucket. You'll need to set aside some money just to cover any unexpected expenses. This bucket consists mainly of your investment assets, anything you have put to the side from your paycheck. Another major part of this bucket is a long-term care, which is, as you get older, those long-term cares, maybe it's a nursing home, things like that, those expenses tend to rack up fairly quickly. So these do go hand in hand with insurance, but we won't dive too deep into long-term care today, mainly stick to the insurance. The last bucket is going to be your legacy bucket. What are your legacy assets? These may also be investment assets, but you never know how these investments will potentially perform. If we use part of your return from these investments to protect, this life insurance policy, there's, a possibility to help give you more, throughout the process of retirement. The next question is, will you want to leave that legacy? More often than not, it's the legacy assets that get used in that emergency. That bucket that, we tend to not, use as much as possible usually tends to be the one used in emergencies. If the stock market does have quite a bit of dip and you need more money for retirement, or you maybe get hit with some of these unexpected expenses we speak of. This is to emphasize why life insurance is so important. These legacy assets get used in retirement, and sometimes they aren't always planned correctly.
So now I want to take some time to go into the different types of life insurance, and I'm going to start by explaining three key components that are going to make up every single life insurance policy. So what I want to do here is I just want to zoom in really quick so that you guys will be able to see this. So there are three aspects that make up your life insurance policy. There's the premiums, the death benefit, and cash value. Most of these are pretty self-explanatory, but the premiums are what you pay into the policy, whether you do that on a monthly basis, quarterly, or annual. These premiums are used to fund this life insurance policy and keep it in place, and it's going to fund the death benefit and cash value as well. So the death benefit, that's going to be what your beneficiary receives in the event of your passing. So whatever that number is, that gets passed on to whoever your beneficiary is. And in most cases, that's going to be income tax free. The cash value is a separate account which builds over the life of the policy. And this can actually be used as a living benefit where you could access some of the money while you're still alive. So I know most people, when they think of life insurance, they think they're not going to be able to use it while they're still living. This is just going to be passed on to somebody else once you pass away. But what most people don't know is that a lot of policies, specifically permanent insurance policies, hold a cash value that you're actually able to have access to during your lifetime. So before we get into these 5 different types, there's 2 generalizations or general types of insurance. There's going to be term insurance and permanent insurance. So term insurance is for a specific interval of time. For example, if you have a term insurance 20, that is going to cover you for 20 years. And these term insurances come in several different years, whether it's 10, 15, 20, or 30 years. So the pros to having a term insurance policy is that it's always going to be the cheapest, and it's usually the highest way. It's usually the way to attain the highest death benefit. But some of the cons to having term insurance is that there's going to be no cash value that's built, so you won't be able to access any money during your lifetime, and it's only for a specific time. So if you live past those 20 years, for example, the policy is going to be done, and you're going to need to renew that policy or get a new one. So all that money that you've put in and the premiums that you've paid over the course of those 20 years, those are all lost because you made it past those 20 years through the term insurance. So that's number 1. Permanent insurance is numbers 2 through 5 that you see here. And there's different variations of permanent insurance, and we're going to dive a little bit deeper into each one. So, just to get started, the first one you see here is term insurance. Looking at this graph, you'll see that this line right here represents the premium. And then in these over here, you have the death benefit on the y-axis. And this blue line actually mimics the cash value that grows over time. So like I mentioned before, there's no cash value in the term insurance. You pay level premiums that are going to be the same throughout that entire duration of the policy, whether that be monthly or annually, and the death benefit is going to stay the same as well. So this just gives you pure protection and no cash value. Next, we have a traditional whole life. So this is permanent insurance. And the key part of permanent insurance is that it's going to cover you until you die, until you pass away, which is an extremely important aspect of life insurance. If you're able to keep the policy intact by funding it correctly, it's going to cover you your full life, and you don't need to worry about outliving your policy, which is something that a lot of people run into, especially with, longevity definitely becoming, a bigger thing in our society. So in traditional whole life, the death benefit is going to be fixed, or it could actually increase as well as you build value in the policy. The premiums, though, they will stay fixed the same throughout your life, and then you will have protection, and cash value will grow within this traditional whole life. So a variation of this is going to be universal life insurance. So just like the one before, the death benefit is going to be flexible or fixed. But in this case scenario, you could see the squiggly line. The premiums are going to be flexible as well. So that means you could increase or decrease the premiums based on where you're at in life, and how the policy is performing, and how it's doing. So there's going to be a limit of how much or how little you can contribute to keep it intact, but you have a lot more flexibility and leniency of how and when you make those premium payments. And the cash value will grow. You can see this graph over here. It's going to grow declared based on an interest rate. So that whether that be 1, 2, 3, 4, or 5%, that is how the cash value will grow. So moving down, we have indexed and variable universal life, which is a variation of the third one. An indexed universal life policy is the same when it comes to the death benefit. It's going to be flexible or fixed. Premiums are going to work the exact same way. And the way the cash value grows is actually going to be based on an index linked interest rate. So what that means is basically when you hear how the market is performing, it's usually referred to the S&P 500. So for example, that cash value will be linked to that index and it's going to grow the same as that index grows. And then it's going to give you protection, and then you have access to this cash value as well. And then the final one, which I believe is a great tool, is a variable universal life. So just like the index universal life, it's going to have a flexible or fixed death benefit and flexible premiums. But the cash value is going to grow or decline based on its performance with market-based investment options. So this is where you're actually able to invest in different mutual funds and different stocks, and that cash value will grow based on those investments. So of course it can grow or decline, but this is going to give you the highest or the best opportunity to grow that cash value. So you will have access to some of this money while you're still alive. Next, I'm going to hand it off to Alex, and he's going to kind of go get started and discuss max strategy with us.
Yeah, so some good information on life insurance from Jared. What I'm going to get into is just sort of your pension. I would say most of you are here today, just you're either at or nearing retirement. And as many people in your situation, you'd like to have, the assurance that you're going to have enough in your retirement to live that same life or something close to it. Many of you may also be concerned if your spouse will receive that income if you were to unexpectedly pass away. And, if you're going to have enough money in that pension plan or other assets, depending on who passes away first. Retirement for you, you want to reap those benefits that you planned, your entire working career, whether it's in a retirement tool or a pension in that aspect. But, sometimes the preparations aren't enough. What if, primarily you counted on, your pension and it may be, at the same or a little less than what you thought it was. The strategy that we're going to go into briefly is just pension maximization, which is, you create a source of funds to provide income for your spouse and potentially increase that income for yourself at retirement. Our first topic we're going to deal with is the decisions you have to make at retirement to plan your assets. Next, we're going to kind of go over just those decisions that you'll have to make and go over everything just in depth. At or prior to retirement, you may be required by your employer to make an irrevocable decision to choose how your pension assets will be accumulated. Usually what we have on the slide here is you're going to take either a survivor benefit or no survivor benefit, meaning you'll take the full value of your pension, or if you plan on leaving it to a spouse, you're going to take a slightly reduced benefit. And if you were to pass away, that reduced benefit will go to your spouse indefinitely. But these choices do have advantages and disadvantages. And we can discuss those just based on personal situations or, when you plan on retiring. The next part is if you do decide to take the single life pension benefit, you will most certainly receive the highest benefit, but that benefit will cease, as soon as you were to pass away. So maybe using the option, maybe in your best choice, if you don't have somebody to leave it to. If you do have a spouse, I would say once you die, that benefit will go away, and you obviously want to maintain that money considering you worked so hard for it throughout your career. The next part is the joint life pension. We're going to go over just the advantages briefly. Your spouse will receive the full portion of your benefits if you should die before him or her. If you do decide to go with that joint pension, I think the biggest advantage to it is you do have somebody to leave it to if something does happen to you. The biggest disadvantage, I would say, is while you are living and your spouse will receive that smaller benefit, you had elected the single life option. In many plans, you have a joint survivor benefit. So if your spouse does die and continues to receive those reduced benefits, in this circumstances, the retiree and the spouse receive no benefit from this election. Neither choice, I would say, if neither choice does sound appealing to you, fortunately, there are additional options which we can pension max these options as well.
Okay, so now we want to go into the pension max. And now that you know the differences with the pension options, Now we're going to see the pension max in action. So just to reiterate, when you elect to save your pension plan at retirement, FRS is going to give you 4 different payout options that you must choose from. We're going to go into the 2 most popular options, which is taking the full amount that will only cover you for the course of your life, or taking the reduced option, which is actually 80% less than that original option. So the option, we call it option 3, is going to be 80% of option 1, but it's going to pay out for the duration of your life plus your spouse's life in the event you pass away. So the pension maximization strategy, it combines purchasing a life insurance policy with while electing the maximum pension benefit option from your pension that will have no survivorship benefit. So what we want to do is purchase a life insurance policy and take the maximum pension benefit. With this strategy, you're going to be able to maximize your pension benefit during your life. You're going to help provide for your spouse's financial independence through life insurance coverage, and you're going to be able to use existing savings to supplement your retirement income. This concept can work if life insurance is purchased before or at the time of retirement. And current health is a very important factor in applying and implementing life insurance. Therefore, it's generally better to ensure that the proper insurance is in place now to help provide a secure retirement income for your spouse. The earlier you do this, the lower the cost of insurance and the greater the death benefit is going to be. So before deciding if the pension maximization strategy is right for you, here are some of the points to consider. Do your pension annuity payments have a cost of living adjustment? For those of you in this meeting that have years in the FRS before 2011, you actually will have a cost of living adjustment. What this means is that your pension each year is going to increase by a slight percentage point, and this is really to keep up with the inflation and other economic factors. So if you have any years before 2011, you're going to have a small percentage that increases your pension. So if your pension annuity payments have a cost of living adjustment, you would need to consider purchasing a larger amount of insurance in order to provide your spouse with a comparable retirement income. And then also, like I kind of mentioned before, will you be able to qualify for life insurance? The plan participant whom the insurance would be issued should ensure that they can qualify for life insurance before making any decisions in regards to the payouts from their pension plan, their employer's plan. So now let's take a look at the pension max in action. So the following graph illustrates how pension maximization works while both you and your spouse are living or when only one of you is alive. So in this first section right here, while both of you are living, the employee would pay the premiums into the life insurance policy. And that policy is going to those premiums are going to get credited interest and the policy values are going to grow. The death benefit could increase as well as the cash value that's built in it. So if you die first, which is you as the policy holder, your life insurance policy is going to pay the proceeds to the designated beneficiary. And then what your beneficiary is able to do is actually invest the proceeds from the life insurance policy to create an income stream that would be similar to what you would have received in the pension if you took the joint survivorship one. So you are able to recreate that pension stream with the proceeds that are going to be income tax free from this life insurance policy. Another important note that I want to mention here is that in your pension plan, you're limited to the beneficiary that you could choose. In almost all cases, you could only list your spouse as the beneficiary to your pension plan. The good news about life insurance that Alex was kind of touching on was that you could actually change the beneficiary and leave it to whoever you want, whether you choose it to your children, grandchildren, or a charity. You're able to change those designated beneficiaries, which you're not able to do in the pension plan. And then moving on into the third scenario, if your spouse dies first, you still have your pension plan. So this FRS will still pay you out your pension plan, and then you will be able to do whatever you want with this life insurance policy. You could either cash it out with the cash value and use that money while you're still living, or you could change the beneficiary to somebody else and you'll still be able to leave a legacy. So now let's take a look at a hypothetical example. So This is Carl Robinson. He's age 52 and he's married to Catherine, age 50. Carl has been working in the FRS for the past 25 years and is planning to retire in 13. Carl received an estimate that at age 65, he would receive $2,500 a month from his pension plan if he takes the option that gives him the most. On the other hand, he can choose the second option that's going to give him 80% of that original amount, but that will cover him. It will cover him and Catherine for the duration of both of their lives. If Carl elects this option, his payments are going to be reduced to $2,000 a month, but Catherine will receive $2,000 a month for the rest of her life after Carl's passing. So if Carl were to implement the pension max strategy, he's going to be able to choose the maximum pension benefit, which is $2,500, and he's going to be able to purchase a life insurance policy prior to his retirement using the difference in the money he is taking home. So you see here, because he is taking the option with no survivorship benefit, he's actually taking home an extra $500 more a month than what he would if he took the reduced one. So with that difference, doesn't have to be all 500, but he's able to use that difference to purchase a life insurance policy. And this will allow him to maximize his retirement benefits, his retirement income, but he's also going to set Catherine up with even a possibly larger income after he dies. So as I previously mentioned, it's better for Carl to purchase the life insurance policy sooner than later, because this is going to reduce the cost of insurance and help him take advantage of his good health. So he's going to be paying less, so he can even pocket more of that $500 difference, and that income stream that Catherine's going to receive could be even more if he has a good rating. So to wrap it up, there's a few things that I want to touch on and things that need to be considered when applying and implementing and doing life insurance. So I want to emphasize once again that every person's situation is different. So the strategy is not going to look the same across the board. Everybody's financial situation, age, and retirement horizon, all of that factors into this strategy. So everyone's going to be different. And like I said, it's going to be it's going to vary across the board. And once again, I can't stress how important it is that the most important thing about applying for life insurance is your health. If you get a good health rating, you're going to be paying less for insurance, and you're also going to be offered a higher death benefit for your beneficiary. Also, just to touch on it once more, for the pension, your beneficiaries can only be your spouse, with a few scenarios that might change that. But life insurance, you can make that beneficiary anybody, and you can change that at will whenever you want. So overall, the strategy for the pension max, just to reiterate it and tell you exactly what it is and how life insurance is used. In this strategy, you're going to be taking the highest pension payout option, which will increase your retirement income. And you're going to use the difference from what you would receive in the highest option from what the option you would receive if you left it for your spouse. You're going to take that difference and you could use those proceeds to pay for life insurance. This will allow you to take home the highest amount from the state that you've worked so hard to earn over the past, 10, 20, or 30 years. And you're going to be able to take home the most from there, and then create an income stream from the life insurance proceeds for your spouse in the case you pass away. And they're going to be able to replicate what the pension would have done, and if not, give them even more income when it comes to living on past your passing. So that's everything that we wanted to talk about today. Sorry, a little bit short on the time, but we really appreciate you taking the time to come out and listen to this presentation. I hope you found it very insightful and were able to learn a thing or two about life insurance and how you can use that with your pension. So I guess now I'll open it up to questions.